Okay, let's just go through the PowerPoint, which is the fiscal year 2013 financial report on the status of the plans. So as you can see from this frame, as of June 30, 2013, we had a little over 53,400 total participants, both active and retired. In terms of the PSPRS alone, the total number of participants was a little over 31,500. For the corp plan, the total number of participants was just under 20,000. And for the elected officials plan, the total number of participants was a little over 2,000. This frame is interesting just because of the comparisons between the number of active employees relative to the number of persons drawing benefits. So for example, if you look at this column here labeled PSPRS, you'll see that as of June 30, 2013, we had 21,360 active participants paying into that particular plan. And at the same time, we had 10,159 persons drawing benefits from that plan. So the ratio is a little better than 2 to 1. In terms of corp, the picture is actually much better because there we had over 16,000 active employees paying into that plan relative to a total number of beneficiaries that aggregated just 3,810. So the ratio there is better than 4 to 1. EORP is problematic. Here you only had just under 1,000 active contributors, whereas in terms of benefit recipients, we had over 1,000 drawing benefits. So of these three plans, the EORP plan is the most precarious, and I think that was one of the factors that prompted what the legislature did in the last legislative session. And I'll come back to that and talk about it further as we go along. Okay, in terms of revenue, total revenue for the fiscal year was nearly $1,400,000,000. And of course, most of that came from the net investment return. That amounted to $723.2 million. Contributions were also a significant factor. The employer contributors paid in $461.7 million, and the employees paid $185.7 million in contributions. The other sources of revenue here are just the miscellaneous court fees and payments for service credit purchases and transfers. In terms of outlays, the total expenses for the fiscal year were $762.3 million, and primarily those are benefits of one type or another. Most of them are pension benefits, but there are also survivor benefits, disability benefits, insurance benefits, drop payments, and refunds to terminating employees. In terms of cash flow, and this is just simply payments going out the door relative to contributions coming in, we had a negative cash flow, which, given the plans we administer, is to be expected, but that was more than offset by the investment return on the assets of the system. So although the cash flow is negative, again, with plans like these, that's not an unexpected event. Let's talk a little bit about this. This was the asset allocation at June 30, 2006. And as you can see, this is very plain vanilla. Over 70% of the system's total assets at that time were invested in stocks. But actually, that's a little deceptive because given the fact that the money was being managed internally, the stock component consisted only of large capitalization U.S. stocks and some mid-capitalization stocks. There was no exposure to international equity of any kind. There was also no exposure to small-cap U.S. stocks at that point. And the bond component was also rather plain vanilla. This is U.S. corporate bonds, amounting to 21.4% of the fund at that time. Real estate, too, is a little misleading because the real estate exposure the system had back then was primarily investments in residential real estate concentrated here in Arizona and in the contiguous states here in the Southwest. So it was not reflective of the investable real estate market at that time. So when you look at this picture, although there is an asset allocation, it's not as robust as it could have been at that time, and certainly was not relative to what other public funds were doing back at June 30th, 2006. To go to the next frame, this is what it looks like as of October 31, 2013. And here you can see the asset allocation is far more diversified. It has many, many components to it. The exposure for equities, which here is U.S. equity and non-U.S. equity, has declined from, as it was, over 70% of the fund at June 30, 2006, to about 34% currently. What we've done is, especially over the past 3 years, once we got the statutory authority to use external asset managers, the movement has been to reduce the exposure to equities and increase the alternatives to equities, which is what all these other components really represent. And in doing so, we reduced total risk for the fund. And so we are now a very well diversified system relative to other public systems. And we're also very well diversified within the asset classes themselves. And that's a very important factor because it decreases the volatility and will, over time, help us to produce a more stable pattern of investment returns. Let me skip through these frames and go to this. This is the gross return for the fiscal year at June 30, 2013. So for the 12 months, the system had a total return on assets of just over 11%. And on a net of fee basis, the return was 10.58%, which was a pretty strong return. The benchmark return for the fiscal year came in at 10.09%. So the gross return certainly was better than that, and even the net of fee return was better than that. So we had a pretty good year. Also, keep in mind, the actuarial assumed rate for this system was 7.85% during the fiscal year. So we did much better relative to the actuarial assumed rate of return, and we did somewhat better relative to the benchmark return, which is just what the markets would have given us, given where we had the assets invested during the 12 months of the fiscal year. Let's turn to fiscal year 2014 now. So we have returns for the months of July through October, and as you can see, these are the month-by-month returns on a gross of fee basis, and these are the fiscal year-to-date returns. So as of the 31st of October of this fiscal year, we have a gross return of 6.44%. Now, I hesitate to extrapolate that to June 30 of 2014. It'd be nice if we could, because that would tell us that we're going to have another very strong rate of return for the fiscal year, which would be really nice to have. We'd have two very, very good years back to back, and that certainly would help in a lot of ways, especially with the funding ratio and with the employer contribution rates. But I'm not in the business of predicting the financial markets, and I have no idea what's going to happen, especially what's going to happen when the Federal Reserve begins to reduce their bond buying, which has been stimulating the markets. It's stimulating especially the equity markets. This frame here has the asset allocation, and this frame shows you what this fund looks like in the aggregate relative to other public funds. So as I was describing earlier, our exposure to equities has been reduced, and relative to other public funds, we have much less equity exposure. We have somewhat less fixed income exposure, but we certainly have far more alternative investment exposure than other public funds. And again, that was done just to reduce the volatility level of the system. You can pause and look at this for a moment. These are returns on a 1 year, average 3 year, average 5 year, and average 10 year basis relative to the benchmarks. So as I pointed out earlier, for the 1 year, we did pretty well relative to the benchmark. For 3 years, we underperformed. But for 5 years, we were doing somewhat better. But these returns certainly are rather low because they take into account the loss years going back to 2009, which was a very serious year for asset losses. Let's go to this. This shows you on a year-by-year basis how the plan did relative to the benchmark for that particular time frame. And we'll go back to here. This is fiscal years 2001 and 2002. I know many of you heard this story before, but back then, as you can see, we seriously underperformed the benchmark. The returns were sharply negative, and there's a reason for that. And the reason was that during the late 90s, the system's investments in stocks and bonds were increasingly concentrated in high-tech and telecommunications securities. And, of course, beginning around March of 2000, the tech telecom bubble began to deflate. And so having ridden the bubble up, the system rode the bubble all the way back down. And so this is an example of what not to do in terms of investment activity, because this was a highly concentrated exposure to a very small portion of the equity and bond markets at that time. And the system paid an enormous price for this, as I'll show you in just a bit. We go to these years here. This is fiscal 2003 through 2007. Things look much more normal. The returns are positive. And in most of these years, the system did better than the benchmark. However, this is a little misleading too, because in many of these years, the system could have done significantly better than what we actually did. And the reason why is because some of the best performing markets during that time frame are markets to which this system had no exposure whatsoever. And the reason we didn't have the exposure is because we would have had to use external managers to get those exposures, and we didn't have the statutory authority to do that. We only got the statutory authority to use external asset managers in 2008. So having gotten that authority and having begun to change and diversify the asset exposure, the markets took a tumble, a very serious one, as you well know. The real estate market collapsed, and then the economy, not only the U.S. economy, but the global economy, went into recession, and that certainly took a toll on the asset values of the system. As you can see, in fiscal years 2008 and again in fiscal years 2009, the system had sharply negative returns. We underperformed the benchmark in fiscal year 2008, largely because of the need to write down the value of those residential real estate properties that the system was holding and had invested in many, many years prior. In fiscal 2009, we certainly outperformed the market by quite a bit, but still, on an absolute return basis, the return was negative 17.45%. And then things look much better in fiscal year 2010 and fiscal year 2011, where we outperformed the benchmark and had very good, very strong returns. But again, we ran into trouble in fiscal year 2009, where the return was slightly negative. The gross return was a negative 0.32%. On a net of fee basis, I believe the return was a negative 0.79%. So we underperformed the benchmark in that year, but even that was not a very healthy return. Even if we'd gotten the market return for all the asset classes where we had exposure, the return on a gross of fee basis still would have been less than 3%. So we would have underperformed the actuarial assumed rate of return anyway. So now we get to fiscal 13, and the results there, as I just showed you, were very positive. Okay, so there are consequences to all of this, and this demonstrates and captures those consequences. What you see when you look at this particular chart is that over this period, from fiscal year 2005 through fiscal year 2013, the trend is down. So the funding ratios for all three plans have been declining fairly steadily throughout this entire time frame. And we expect this trend is going to continue for a while. I say that because this public fund, like most public funds, uses an actuarial smoothing method, factoring in each year's rate of return results. We use a 7-year smoothing process, ASRS uses a 10-year smoothing process. So in effect, what that means is that it takes a full 7 years for the results from any 1 year to be captured in the actuarial value of assets. So we are still factoring in the losses from fiscal years 2008, 9, and again fiscal 12. And eventually when those loss years drop out of the calculation, then things are going to turn around, and hopefully we'll begin to see a very sharply increasing funding ratio trend for the plans. In the short term, the only thing that will reverse this or moderate it, if you will be better than expected rates of return. And I mean better than the actuarial assumed rate, which, as I said earlier, was 7.85%. If this fiscal year turns out to be a very good return year, and we significantly outperform the actuarial assumed rate of return, then the trend will moderate. I won't promise that it will reverse. It depends on where we are at June 30, 2014. But what we really need is better than expected returns over a period of years. 4 or 5 years will certainly make a difference. But again, we're not in the business of forecasting what the financial markets are going to do or not do. In any event, as the funding ratios come down, the automatic stabilizer kicks in, and that happens to be the variable, which is the employer contribution rates. So as the funding ratios come down, employer rates rise. What I'm showing you here is the aggregate rate paid by all of the employers contributing to the PSPRS plan. And keep in mind, for the PSPRS plan, there are about 250 separate groups in that plan. And each group has a different contribution rate. But this is just the aggregate rate. So right now, well, if we go back to fiscal 2003, you'll see the employer rate was very low at 3.75% of payroll. But as the funding ratios have trended down, the rates have been rising, in some cases rising rather dramatically year over year. The current aggregate rate paid by all the employers contributing to the PSPRS plan is at 30.44% of payroll. Based on system fiscal year 2013 results, that aggregate rate will rise to 32.54% effective July 1 of 2014. For Corp, the trend is the same, but the rates are better. Again, going back to, in this case, fiscal 2004, you'll see the employer rate was just under 4% of payroll. The current rate is 13.68%, and that is scheduled to rise to 14.46% as of July 1 of next year. In terms of the elected officials plan, there are actually two rates here. There is the unsubsidized rate, which is the rate paid by the cities and towns on behalf of the elected officials that they have in the plan. And then there's the subsidized rate, which is paid by the state and the counties. And the state and the counties get the benefit of judicial filing fees, which helps reduce what they have to pay in contribution to the elected officials plan. Again, the trend is the same. Rates have been rising. Currently, the unsubsidized rate for the elected officials plan is just under 40% of payroll, and the subsidized rate paid by the state and the counties is just under 26% of payroll. Now, when you look at what's going to happen come July 1 of 2014, the rates are going to rise suddenly and dramatically. And again, that is because of what the legislature did during the last legislative session. To make it short and sweet, what they did is to close the EORP defined benefit plan to new participants. All new participants will go into either the defined contribution plan that we have been authorized to set up and administer beginning January 1 of 2014. In some cases, new members of the plan will be able to opt into the Arizona State Retirement System if they had prior exposure or prior experience and coverage in the ASRS system. And whenever a plan is closed, the actuarial requirements and financial reporting requirements change. The GASB requires that we use projections for employer contributions based on a level dollar funding mechanism as opposed to a level percent of payroll, which is what you normally use actuarially if your plan is open and new hires are coming into that plan. But that's a little misleading. Even though we'll have to report this for our financial statements, the actual rate, which was set by the new law when they closed the plan, is going to be 23.5% of payroll for the employers, and that is a fixed rate that is supposed to be in place for the next 30 years. Now, that rate can change, and I will talk about the risks that are involved with this, but the rate will not float. In other words, it's not going to change every year as has happened in the past based on actuarial results. Instead, if there's a need to change the rate, we'll have to go to the legislature and get legislative approval to change the rate. That introduces a rigidity into this new plan, a new system that was not there before. Because as I said, the employer rates really function as kind of an automatic stabilizer. So if conditions deteriorate, then automatically the employer rates rise to compensate for that. If conditions are very good and results are positive, then employer rates would automatically go down. That's not going to happen now unless the legislature intervenes. Let's talk a little bit about this. This shows you what's happened fiscal year by fiscal year, going back to fiscal year 2000 and through fiscal 2013. And let's look at the market value column here. So if we go to June 30 of 2000, the system at that point had $5.6 billion in assets under management. Now, because of the tech and telecom exposure and the losses the system sustained, at June 30 of 2002, the market value of assets was just under $4 billion. So the overconcentration of tech and telecom cost the system $1.6 billion in asset value because of what happened in the markets. And then we see things improving, but then we get to fiscal years 2008 and 2009, and you can see there was a sharp decline in the market value of assets. Things have gradually improved, and at June 30 of 2013, the market value of assets was at $7.3 billion. The asset value, however, is what takes into account that actuarial smoothing process that I mentioned earlier. And so if we go down here to June 30 of 2013, the actuarial value of assets is just over $8 billion, significantly higher than the market value. And what this tells you is that we're still factoring in the losses from the 08 and 09 period and fiscal 2012. So the expectation would be that this number is going to come down, and eventually, and hopefully, this number will continue to rise, and then things will even out, and the trends will begin to reverse. And as I said, if we have better than expected investment return for fiscal year 2014, which is the current year, and then on into the future, then these trends will moderate and reverse. Okay, the next few frames have this on a plan-by-plan basis. You can see for PSPRS, the official funding ratio was just over 57%, but if we were using market value of assets to calculate the funding ratio, that ratio would be just over 51%. For Corp, the picture is better. The official funding ratio, using actuarial value of assets, at June 30, 2013, was nearly 67%. Using market value, however, it would have been just under 61%. And for elected officials, here the official funding ratio is at 55.5%. At June 30, 2013, using market value, would have been just under 50%. Okay, let me just pause and ask if anyone has any questions on any of this material. I know a lot of this material is on our website. You've probably already seen it. And probably the only thing here that's new that you haven't seen is the fiscal year to date update.
Say again, you said that EORP members can join ASRS if they want to. Did I catch that correctly? If they meet certain requirements?
Yes, you did. Let me talk about what the legislature did last session. Okay, number one, the legislation that passed closed the elected official defined benefit plan to new hires. Okay, so beginning January 1 of 2014, anyone who is a new participant in the elected officials plan will have choices. They can utilize the defined contribution plan that we're in the process of setting up right now, and we will implement that plan come January 1. However, for anybody who's new in the elected officials plan who had prior service at ASRS, they will have the option of opting into the ASRS plan. They don't have to, but they have that option. And if they do, they'll be covered by the ASRS program. The system here will get the contribution income from the members and from the employers as normal. And that income will be used, number one, to pay what is required for the now closed defined benefit plan. And the actuarial projections are such that the unfunded liability for the closed defined benefit plan should be fully amortized by the end of 30 years. But that assumes that all the actuarial assumptions turn out to be true. Now, also, the employer contributions for those who have defined contribution accounts will be 5% of pay. The individuals will pay into their own accounts. It'll function just the same way as your deferred comp accounts function. And then for the employer contribution to those who end up opting into ASRS, the rate that will be paid is whatever rate ASRS will set for the employers. And in the case of ASRS, and unlike here, the required contribution, which is determined annually based on the evaluation results, is divided 50-50 between the employees and the employer, and that rate changes every year. So what are the risks to this structure? Well, as I said, the employer rate is now fixed by statute at 23.5%. That could turn out to be wrong. I'll give you some examples of why there's risk here. First of all, if we don't achieve our expected rates of return because of conditions in the financial markets, then increased contributions will be required. But they won't happen automatically. We'll have to go to the legislature and say, there's a deficiency to report. The current statutory rate is insufficient to fund the system in total, and we will ask the legislature to raise the rate. The legislature, of course, can accede to that request or not as it chooses. If it doesn't, then there's a risk that we would actually run out of money before all the liabilities of the closed EORP plan are satisfied. There are other risks. Suppose, for example, the Arizona Supreme Court decides at the end of the day that the changes that were made in 2011 by the so-called pension reform bill are unconstitutional. Well, we'll have to go back and make changes, and those changes will inevitably involve increased liability, and that increased liability will require higher contribution rates, but the rates are subject to legislative action. And there's no guarantee that even though they may be required, legislative action is not something that we can predict with any kind of certainty. We would hope that lawmakers and policymakers would be responsible in a situation like that, but there's no guarantee. Okay, any other questions either on that or anything else? Okay, then let's see. Let's go to this next presentation. Okay, we sent out a report that we got from our actuary. I had asked the actuary to do some work for us. and make some special projections. The projections are for the PSPRS plan. And what I basically asked them to do was to assume that legislation is passed modeled on what the legislature just did for the elected officials plan, but applied to the PSPRS plan. What I really wanted to know is what the employer contribution rate would have to be on a conservative basis over 30 years in order to pay off the liabilities for a closed PSPRS plan and also fund employer contributions for participants or new participants in a DC plan, as was done in the case of the elected officials plan. Well, you can read through the text of this report. I'm just going to focus on what really is important here. Go to this. The actuaries had to do stochastic projections to come up with this. In other words, they take into account variability, and this is all probability based. So if, for example, over the 30-year period, employers were paying a fixed rate of 27.5% of payroll, that would mean that there's a 75% probability that by 2042, the closed plan, would only be 46% funded. And then at that point, there's no payroll base left on which to produce the funding. So that's a problem. The rate certainly has to be higher. So they tried a 33% flat rate. Well, the good news here is that with a 33% flat rate, there's a 75% probability that a closed PSPRS plan would be 100% funded by 2042. So all the liabilities would have been satisfied. There'll be no payroll base at that point left, but there are risks. For example, suppose after 2042, the system fails to achieve its rate of return as expected. Then automatically an unfunded liability develops, and that unfunded liability could no longer be funded based on payroll. It would have to be funded by the employers from other sources, general funding, whatever other resources the employer contributors would have at that point. There are some problems with all of this, some additional problems. These are problems that that the legislature didn't have to deal with in the context of the elected officials plan. The elected officials plan is a pool plan. And in a pool plan, the employers basically pay the same rate. Everybody pays the same thing. Now, there's a minor exception to that in terms of the state and counties because their rate is subsidized. But in the case of PSPRS and in the case of the corrections officer plan, that's not the way things are. These plans are what they call agent multiple employer plans. And so there are different groups in the plan, and every single group has a different rate. As I mentioned earlier, there are roughly 250 separate groups in the PSPRS plan, and every single group has a different rate, depending upon the liability for that particular group. And the employers are responsible for their own groups. So let's take a look at some of the information the actuaries provided. At the top on this particular page, which actually is page 7 of the report, they were looking specifically at the Tucson Police Group. So in the case of the Tucson Police Group, if the city of Tucson were paying a contribution rate of only 33% over 30 years, the Tucson Police Group would run out of money, according to the actuaries, in about 15 to 20 years. So that doesn't work. The rate would have to be significantly higher. The actuaries calculated that the Tucson Police Group would have to have an employer contribution rate of at least 48% for 30 years. And that would give them a 75% probability of being 100% funded by 2042. Assuming all the actuarial projections turn out to be true. And they also did this for some of the other large groups in the plan. They did it for the Phoenix Fire Group. Actuaries calculated that to achieve 75% probability of 100% funding by 2042, the employer rate for that group would have to be 39.1% of payroll for 30 years. In the case of Tucson Fire, the rate would have to be 47.5% of payroll for 30 years. And in the case of Phoenix Police, the rate would have to be 35.6% over 30 years. Now, this is probably the most important page in the entire report. These are the caveats. These are the what-ifs. And the actuaries always include something like this because they don't want to be accused of being wrong or being overly optimistic. So the comments here that are important are comments numbers 1, 2, and 3. In comment number 1, the actuaries are emphasizing that you have to have a different rate for each and every group in the plan. So we would have to monitor each and every group rate over 30 years and report any variance or any deficiency to the legislature, and then they would have to change it for that group. That creates a degree of complication and monitoring that would be quite extraordinary, and it's not something that we have to deal with in the context of the elected officials plan because there, as I said earlier, it's a pooled plan and they're all paying the same rate. Comment number 2 is even more troubling. The projections that I just showed you assume that we're going to generate an annual average rate of return of 8% over 30 years. Well, suppose we don't. The actuaries say that if the rate were to turn out to be only 7% per year, the employer contribution rate would have to be 4% higher than what they were projecting. So in other words, instead of 33%, it would have to be 37% over 30 years. Moreover, in comment 3, there's another risk. The projections assume that payroll over the period of time, 30 years, is going to grow at 4.5% per year. So what if it doesn't? Well, if it only grows at 3.5% per year, the employer rate has to go up another 2% of payroll over 30 years. So now we're at 39%. And if you single out or go back to the Tucson Police example, where they were starting out at 48%, and you add 6% on top of that, then you're well over 50% of payroll for 30 years. So these funding requirements become probably insupportable. And that's really a problem, and that's what I think makes this kind of solution, if you want to call it that, to the financing problem of the system impossible. I don't think these kinds of rates are kinds of rates that employers can live with for 30 years. What we expect to happen instead, as long as the plan remains open, is that even though rates are rising and will rise in the short term in all likelihood, eventually that trend reverses and rates begin to subside. And with that will come relief for the employers. Additionally, there are some other things that could be done to help the situation. For example, in the PSPRS plan right now, we're on schedule to fully amortize the unfunded liability over, I think it's down to 24 years. The board of trustees here does have the authority statutorily to increase the amortization period. It's like refinancing your mortgage, in a sense. They could actually move out the amortization period to 30 years if they so chose, and that would have a somewhat beneficial effect on what the employers would have to pay as a percent of payroll. The percentage would come down by somewhere between 1.5% and 2% of pay, but of course they'd be paying in at a total dollar amount that would exceed what they pay under the current structure. But it is something that we did have the actuaries project for us, so that the board at least knows what they could do if they so chose. I don't think that's going to happen, at least not right away. It could happen, if it happens at all, just before the start of the next fiscal year, and that matter will probably come up for discussion sometime in the April-May timeframe of next year. Okay, that completes this report and what I had to say about it. Does anybody have any comments? Yes, please.
Hi, Jim. First, let me thank you. These meetings for the last few years have been very informative, very helpful to us, and I appreciate you having them. A couple years ago, you produced charts that showed what we would expect the employer rates to be going out. And at that time, you said, based on the current plan structure, the actuary looked out 50 years and it never really stabilized because there were problems with the plan. Legislative changes were made and staff recommended changes, and all of your recommendations weren't adopted by the legislature. Some were. Is there any chance that you could update those charts? Because the most useful thing for this meeting for me is to be able to project 5 years out what our rates might be. At this point, what I know is we're paying 35 to 37% for police and fire. Contributions from employees make that about 50% total going into the fund. The fund had double-digit returns, and yet the fund status is still declining. So it's hard for me to project what it's going to be like 5 years from now. Is there any chance you could produce those charts again?
Yes, what you're referring to are the stochastic projections that we had the actuaries do. They actually did that the first time in fiscal year 2010,
Yes.
and they did it, once they did it, that's what prompted the legislature to enact the pension reform bill in 2011. Now,
I guess what I'm asking for is those
we can
charts
update them.
updated for the legislative changes
Yes.
that were imposed. That would be very helpful for us.
We certainly can do that,
Okay.
and I will. I'll make a note of that.
Thank you.
Okay. Just to refresh everyone's recollection, what the legislature did in 2011 was basically two things. They terminated the old post-retirement benefit adjustment mechanism and put in place a brand new one. Okay? And the second thing they did was to increase member contribution rates, which in the case of PSPRS members was fixed by statute at 7.65%. Those rates have increased significantly since then as a result of the pension reform bill. Now, it's these changes that are being challenged in the courts. We're waiting for the Arizona Supreme Court to decide the Fields case, which is a case that was brought on behalf of the class of all judges who were retired at the time the pension reform bill became law. And what they were challenging were the changes to the old COLA mechanism. Now, we don't know what the Arizona Supreme Court is going to do. The court heard oral arguments in the Fields case back in April of this year, and they still have not handed down their decision. It's the only case that they heard at their last sitting that is still waiting for results. I hope that we will have a decision from the Supreme Court prior to the start of the next legislative session, but there's no guarantee. They will get around to handing out their decision when they get around to it. And if they decide, as the lower court decided, that what the legislature did was unconstitutional, then we will have to go all the way back to 2011 and reinstate the old COLA, and that'll have immediate consequences. First, we'll have to go back and make retroactive benefit adjustments and pay for them. Money will come out of the underfunded PSPRS plan and the other plans and go into their reserves, which we'll have to resuscitate, and then we'll have to make adjustments going forward. What will happen then is when the next valuation is done, which will be the valuation at June 30, 2014, that will result in significant increases in employer contribution requirements to take account of the restoration of the old COLA mechanism. And with respect to the member rate increases, those were challenged too. The active judges involved in the class action in the so-called Hall case challenged not only the COLA changes, but they challenged the increases in contribution rates as well. And if the Arizona Supreme Court ultimately decides that it was unconstitutional to increase member rates, then we will have to refund the increased amounts that members have been paying in and reduce the rates back to what they were prior to that legislation. And then that too will further drive up employer contribution requirements. So there's quite a bit at stake in terms of those pending lawsuits. I think once the Supreme Court hands down their decision in the Fields case, though, we will have a pretty good idea what the results are going to be, and we can start to act on that. And we would expect that the legislature will take some action no matter what the Supreme Court ultimately does. But it'll be based on the Supreme Court's decision, because that'll serve as a roadmap as to what is and what is not constitutional. Okay, any other comments, questions? Okay, we're going to continue, by the way, to provide information via our website, so do check that periodically, because as we have new information to report, we will be updating the material that's there, and that's a pretty good source of information for everybody. Okay, we got some questions? Okay, bring them up. The question is, which ratio, asset value or market value, that's actuarial asset value, or market value is used to determine retirement COLA? That's a good question and a timely one. Let me talk about the new COLA mechanism that the Pension Reform Bill included. Beginning fiscal 13, anytime the system generates a rate of return of in excess of 10.5%, that rate of return, that excess rate of return, and the assets that excess return represents, will be used to fund a lifetime adjustment in benefits for all of the eligible beneficiaries at that point. Now, so it's really the rate of return that's going to be the determining factor in how the new mechanism operates. And just for your information, in fiscal 13, as I just showed you, we had a very substantial rate of return. Net of fees, it was 10.58%. Well, that's better than 10.5%, and so there are some excess assets that were generated that can be used to fund an adjustment. But there's an important caveat. One of the elements of the new COLA mechanism is a requirement that the plan, in order for there to be any adjustment, has to be at least 60% funded. As I showed you earlier, at June 30, 2013, neither EORP nor PSPRS met that 60% threshold. So even though we had a better than 10.5% return, there will be no adjustment for the beneficiaries of those two plans come July 1 of 2014. However, there will be an adjustment for the corp eligible retirees. It'll be a minor one, probably less than 1%, but it will be an adjustment. And we'll use those excess assets for their benefit because the corp plan had a funding ratio in excess of 60%. And going forward, if we have a better than expected return during this fiscal year, and of course we'll know that, we won't know until we get to June 30, but let's assume we do. Then based on that, if there are excess assets, and there probably would be, we will be able to fund adjustments for PSPRS, Corp, and EORP retirees at July 1, 2015. So that's just the way the new mechanism works. It was designed to get away from the old reserve structure that was providing post-retirement adjustments every year, whether we had a good year or a bad year. Now it's going to be, there's a strong probability that there'll be adjustments. They just won't be every year because there'll be good years and bad years. And not every year we will have a return in excess of 10.5%. Yes?
I think that question is it the asset value or the market value that it has to be 60%?
Oh, I see what you mean. Yes. I think it's market value. It's market value. Yes. I think actuarial value? Yeah. Actuarial value. Sorry, stand corrected. Okay, and the next one, when do you expect the Arizona State, well, the Arizona Supreme Court will hand down their decision when they get around to it. I say, we were hoping that decision would have come down already. It's the only case still pending before the court, and it certainly would be nice to know what the results are in that case prior to the startup of the next legislative session. But, you know, it'll happen when it happens. We'll only get 24-hour advance notice of their handing down that decision. Okay, are you proposing that the PSPRS go to a DC plan? If not, why the study? No, I'm not proposing, we're not proposing that or anything like it. And the purpose of the study was to demonstrate that to do something like that, or to do what was done in the case of EORP, is probably not financially supportable. Any other questions, comments? Okay, thank you all.